Hi, thanks so much for joining in. You're watching the Mutual Fund Show, and my name is Alex Matthew. Today, I'd like to focus on portfolio construction, not just your own when it comes to selection of mutual fund schemes, which, by the way, is very important that you don't hold too many schemes. We'll get to that in just a bit. But also with regard to the portfolio construction of the fund managers that you choose to trust with the money that you're investing in, particularly in equity. Now, one option that is available to you is to go to a certain scheme that has the ability to go to various market capitalizations, and that is the flexi cap or the multi cap route. And you may not be aware that most flexi caps actually have a large cap bias. So, setting your expectations is important. So, if you do want to have a more or less equal allocation or certain specific allocation towards large cap, mid cap, and small cap as a category, then is the flexi cap, multi cap route the better option available? Or should you, in fact, go to a specific large cap, mid cap, and small cap allocation? That's the first part of this conversation. We'll also talk to you about a few interesting trends that are emerging when it comes to SIP flows. But joining me on this show, I have Juzer Gabajiwala, who is director at Ventura Securities, and Arvind Rao, founder of Arvind Rao and Associates. Juza, as well as Arvind, thank you so much for taking the time. Pleasure speaking with you as always. Juza, I was referring to your own report, Venture Securities, about the market cap allocation when I was talking about the bias towards large caps for flexi caps. Now, how do you think that investors should set their expectations when they're looking at portfolio construction? Should the construction of the portfolio of the mutual fund scheme itself be a primary determining factor?
So, first of all, thanks for having me, Alex, on your show. And just before answering your question, we can just take a step back. That the reason why we looked at this basic allocation that on the market capitalization. So if you see, SEBI had introduced a standardization of the market cap in 2017. So it is a good 6-year time horizon, and at that point of time, most of the funds had multi-cap, and prior to that, everybody had a different approach to how they were classifying the market cap of the stock. So what we did is that we tried to look at flexi cap, because that was one category which actually was spun out of, because of the multi cap and flexi cap there was some confusion, and because of that now we have two categories called multi cap and flexi cap. So typically when you say flexi cap, basically what we are giving the fund manager is a completely free hand. Then he can decide whether he wants to be in small cap, mid cap, or large cap, right? So he has full flexibility in terms of where he wants to invest. In multi cap, there is a restriction of 25% in each of the market cap. But what we did also was that we even took 1 year data, so that there is not any recency bias which we had. So we took 1 year data of the portfolio of most of the schemes. And mind you, this has got nothing to do with what the performance can be. We are not talking about any scheme performance here right now. We are only talking about the portfolio construct. So what we saw is that on an aggregate basis, most of the flexi cap funds are hugging more towards the large cap, and it is very minimalistic to mid cap, and small component to small cap. So then it actually questions us that whether you should have a large cap allocation to a person, that is he better off doing a large cap fund, or whether he should be doing a flexi cap fund.
It's a very
So
fair point. Yeah, that's a very fair point.
that was the most important. That was one of the reason of why we try to do this exercise. That that is the fund manager using the discretion, because we all have seen that the mid caps and small caps have rallied in the last 1 year. Large caps have not. So was the fund manager doing that type of switch, or what they were doing? And
so and that's and it's interesting because that ratio has stayed at that average or very close to that 1 year average. continues to remain that way, despite the kind of run up that you've seen in small cap and mid cap, which indicates that they have taken this as a strategic, conscious decision. So, Arvind Rao, the question to you, therefore, is am I better off taking an allocation towards large cap to the extent that I want? So suppose that I have the risk profile that suggests that I should have only 50% allocation towards large cap and I want to split the rest between mid cap and small cap. Should I choose to invest individually into large cap, mid cap, and small cap schemes?
So I think, Alex, philosophically here, it depends upon the investor's mindset. Because when we talk to people, we have found that this is the same dilemma whether you take a ULIP or you take a term plan plus MF. Because there are people who are very comfortable with having clear allocations. Like if they want a mix of large, mid, small in their portfolio, what they would prefer to do is straight away go with the large, mid, and small funds. But then there are always this set of investors who seem to always want a little extra from the fund that they are in. And they are a bit confused in terms of whether they should be in large, mid, or small. So for these set of investors, such a category of fund, whether it's the flexi cap, makes good sense because then they know that they have their leg in most of this. So, a point that generally we make to these investors here is that while you do this, it's not right to have expectations that you will get returns which probably a plain large, a mid, or a small would do. So as long as you're happy with going in with a blended fund, then be happy with blended kind of returns. So returns could be slightly higher than a large cap fund, but maybe lower than mid and small. So as long as an investor is comfortable with that, then I think a flexi cap makes sense in their portfolio.
So that's Arvind's view. Juzer, I didn't let you make your conclusion to that. So I'm going to come back to you on this one and effectively the same question, but there is a further leg that you've done. I think you've gone further and you've looked at large cap, mid cap, and small cap biases as well, these schemes. And you have found that within these as well, even if it's a mid cap fund, there is a certain amount of large cap bias, or there is a certain amount of mid cap bias or broader market bias in the large cap funds as well. So, how do you take that kind of information to make a selection if you're looking to invest in an equity fund?
So see, I think the major thing was that here we had seen quite a lot of flexi caps were actually underperforming, and
Yes.
that was one of the basis of doing this research, right? And one another part, I mean, which is there a part of our report is that the perception, there are many perceptions which we have in our mind. Most of the investors they actually think that some companies are perceived to be a large cap or a mid cap, but in reality it could be a small cap. Okay, so a classic example being, let us take, Pfizer. So Pfizer is, perceived to be a large cap, but is actually a mid cap. And this also keeps on undergoing a change. So typically, like for quite some time, Bombay Stock Exchange itself was a small cap stock. It's only that now because it is run up that it will more or less likely to get classified as a mid cap stock. So, so having said that, like, now when we are giving flexibility to a fund manager, then I would expect him to use that flexibility, right? So, according to me, then it makes more sense to if somebody is looking at a like a flexi cap fund. I think he would is he not better off by doing into a multi cap fund because at least that he will have a 25% exposure to a small cap and 25% exposure to a mid cap, and then whether he has got 50% exposure to a large cap, it will still be lesser than a flexi cap fund.
That's an
So
interesting point because in the graphic that you have shared with me, the multi-cap funds by and large over the last year had a large cap allocation of 41%. And as of the latest available data, they're very close to that mark, which is 38% or so, which kind of captures the kind of rally that we've seen over the last several months, right, Juza?
right. So and if you see, more or less, they are also over there hugging more towards the mid and small cap. Just a percentage, 2 points here and there. So you'll see around 27 or 28%. In mid and small cap. So they're
Saying
just
is
above the
what you're saying is, instead of flexi cap, if I'm looking for a wide spectrum of allocation and allowing the fund manager to go to various schemes, or rather market capitalizations, I should choose multi cap. That's the conclusion.
Yes,
Okay.
that is what I would say.
So, but then a counter to that, Arvind, would be that there is, in the event of a downturn, a specific amount of money that has to be put into small caps, a specific amount, minimum amount that has to be put into mid caps. Now, generally, you will see that the broader end of the spectrum tends to lose quite a bit of ground. Of course, it gains also equally fast, but then there is a certain amount of risk associated with that. Is that something that should cause you to pause, or do you think this is par for the course for somebody that's looking for a multi-cap allocation?
So I think giving a perspective to the way Juzer put the data and the analysis there, I think people who have in the investor maturity journey, they could start with large cap funds. And before they go into mid and small, they could graduate to flexi cap. And once they're able to gauge their risk appetite and are more comfortable with going beyond the large cap, is when they could straight away jump to multi cap funds also, because then they would have spent some time in the market, understood the way mid cap, small caps perform on the upside or give lower returns on the downside. So then it makes them a perfect time, if I may say, where they could look at slightly more defined allocations the way multi-caps work. So in that sense, at least there is no expectation mismatch or there is no investor disappointment that because normally you see that allocations to mid and small start growing higher on the back of rallies in the mid cap and the small cap space. And typically, as market behaves, whenever there is a rally, it is followed by a downside. So generally, investors in mid and small cap funds are the disappointed lot because they look at the they look at the performance of the last few months or years, and they get into these funds, and then it is followed by a lull. So getting exposure to flexi and then multi will help them to have the best of I mean, a little bit of risk as well as better returns than large cap uh, after gaining some maturity in the market.
Okay, fair point. So taking that point into account, Juza, I would like to get both of your views in terms of, so if you are saying multi-cap as a category should be looked at, then would you be able to give me a few schemes that you have looked at over the last whatever period of time that people should consider, just to narrow the pool of what they're looking at? And then I'll come to you, Arvind, as well. Not just in the multi-cap category, but I've looked at your data, and you've pointed out that Quant, for example, has a smaller large cap allocation. So in that sense, similar to a multi-cap, though it has a larger derivative play that it does, right? And Tata Flexi Cap has a smaller allocation towards large cap, and therefore similar to multi-cap. So from that perspective, it's kind of doing what a multi-cap scheme is currently doing, but it is in that flexi cap category, and therefore it has more flexibility. User.
Yeah, so actually, Alex, the more important point was that we were just trying to figure out over here that how the fund manager has been thinking, that what is his thought process. So that's how we just try to, give some, what is the style the person is following. Like, we were saying that, like HDFC Flexi Cap has 80% in large cap. So he is becoming more large cap bias, right? Quant is becoming more active. Like, so he's a very, very active fund manager. Tata is also trying to be a little bit, more active oriented. So that's just, we're just trying to, bring out some, whether there is some bias towards, in terms of the investing pattern. Like even when you see Kotak, so Kotak has got a large and mid cap bias. So he's, around, I think 70 odd percent in large cap, and then more in the mid cap space and less in the small cap. So we are just trying to bring out how the fund manager is, acting in terms of what he's doing. Now, having said that, to your next question in terms of, recommendation, we generally cannot give any specific scheme recommendation. I can give some pointers more to a person. Is that specifically when a person is looking at multi cap and or a flexi cap as a category, I think the fund allocation is also important, and whether it fits into the mindset of the investor, that whether he would want somebody to be small cap oriented or mid cap oriented or whichever, and take a decision based on that rather than just plainly on the basis of that just going by the returns, because at the end of the day you are taking a call for the future, but the returns are based on the past, right?
Yeah,
So
fair point.
also look at the fund manager continuity, because in these funds you require the fund manager to be a little bit more agile, so that he is also not only able to take a specific stock call, but he also has to take a sector call, but he has to also decide that whether how much he should be in small cap, mid and large cap.
No, fair point. Okay. Arvind, would you be able to share any recommendations that my viewers can look at? Not just so I will leave it to you whether you want to talk about multi-cap and flexi cap, but I think also we were talking about whether or not an investor should look at mid, small, and large, and I think you made your point about the progression of an investor's journey.
Yes, because I mean, as Juzer rightly put it, key recommendations is something which is very tricky, because by the very nature of these funds, names could vary from at different points in time, because data today looks something else, and maybe 3 months later data would look something else. But I think I would, instead, more than recommendations, if I can say that I typically look at in the multi-caps segment, I find there is a Nippon multi-cap which I like. And in the flexi-cap space, in the data which Juzer has shared, I think I like HDFC flexi-cap there. So, I mean,
okay, fair point. So, gentlemen, there was also another aspect that I wanted to talk about, and hopefully this has kind of helped people with the kind of preparation that they need to make when they look at the sector breakup. And by the way, there are several ways in which you can find out the allocation towards the various market capitalizations. If you go to the fact sheets of any of the schemes that you are considering, you will be able to see the portfolio selection of each of these funds. And on the basis of that, you can actually make a judgment as to whether or not you're getting what you intend to get. Now, moving on to the second leg of this conversation, and I want to focus on SIPs. We've spoken about it, gentlemen, quite a bit over the last couple of months, in particular, as we've inched up from that 15,000 to 16,000 to close to 17,000 crore. And very interesting two data points from a report that I was reading. One, it seems like the SIP cancellations as a percentage of the gross inflows into SIPs has reduced to an 11-month low, and it's at 50%. It's still a large number, but does that give you the indication that perhaps people are listening to the advice that people like you are giving out to say that you need to stay longer? Juzer, initial thoughts, and then I'll ask about the correct approach to investing through SIPs.
So I don't know whether investors are listening to us, or are they now, because last 1 year returns have been excellent.
Sure.
Okay, so because, or are they looking at the returns and then they are continuing the SIPs? So, but that is today that's one of the big challenge which we also face, where the expectations of investors is very hard, and unfortunately I don't think most of the investors have understood that how the SIPs function. In fact, we also come out with a report on that, and specifically when there were a lot of this cancellation, because we also run a large SIP book, and for me personally, I always look at that mutual fund is one of the best ways that you can invest through an SIP route. But cancellation is a big cause of concern, and I believe that a lot of cancellations are just happening because investors are not clear in terms of what is required in an SIP, what they need to do.
And what is that?
Oh, so it's like the simplest thing is about the tenure, right? One is the tenure of holding, right? So in fact, it's only an abnormal. This is an abnormal return which you have got for this 1 year when the markets has just run up. Otherwise, if you ask me, I mean, in 1 year, where typically your average SIP investment is just completed 6 months, okay, because one installment is gone for 12 months and one installment is just maybe gone yesterday. So your actual average investment is 6 months. And if you expect your return to be a double digit or a higher double digit, it is just not going to be possible. So I don't see that that if your SIP values, so investors are not looking at the value of the investment.
They're
That
looking at the
how
corpus.
the corpus is very important. That you should start looking at it, that how your corpus is getting built up. So it's like how the insurance companies they sell, and how mutual fund is sold. In mutual fund, we always talk about the returns. But in insurance, you will see that most of the insurance company will say that your corpus will become this much, right? They never talk about the percentage, because that percentage will be much lesser than what is happening on the equity side.
It comes back to setting expectations. But
Right.
so there is also the argument to be made, and I think a lot of people make this argument, Arvind, which is that timing the market can be beneficial if you can do it. Now, I'm no expert, and I don't think that I can time the market, but there may be some people who think that. I don't know what you think. But then, so take for example what Juzer was pointing out, where you have an SIP for a year, and effectively you've had this running for 6 months, right? Uh, but there are people who will say that I have an SIP for 6 months and then I'll hold off because I think markets are too expensive. And then at the end of 6 months, when I see a fall, I will deploy that 6 months together. Is that the right approach?
So interestingly, I agree with your view also on that, Alex, because I think timing, whether right or wrong, that wisdom is always in hindsight when it comes to market.
Yeah.
So we definitely meet these kind of people who say that when markets are rising, I will hold on and then I'll push in the full amount when markets are at a low. But the next question that goes to them is, how do you decide which is the low? So it is futile, because even few weeks back, when markets were on the correction mode, the human psychology says that whenever it is going down, I think there is a little more room left for it to go down, and you wait, and then the market takes a U and goes up. So it is actually futile. And the whole point of SIP, I think, is to get discipline in relation to the investments. And discipline implies that the investments have to go on a monthly, weekly, quarterly, whichever basis the investor is comfortable with. It has to go on. Whatever is the market, whichever level it is at, it is futile to track it. And going with the way you mentioned, that at 50.7, the cancellation rate, it's the lowest in the 11 month. But the same report, what I was checking is also showing that during these 11 months, the highest number that it hit was 67.5. Now, like Juzer rightly mentioned, whether it is the returns that is holding people on, one, or if I were to be too optimistic, I would think that people are now understanding that spending more time in the market or giving your investment slightly more time gives them better results, and they don't get nervous when they see a small bouts of correction or dropping in price happening, and they're happy that if their SIP continues during this time, they are actually helping to build a larger corpus as per whatever timeline they have chosen for their investments.
Juzer, quick question, and then I'll jump into the next leg of this, and we'll wrap. But according to you, for an equity investor, and now normally we talk about this in terms of long term, right? And you're saying more than 3 years at the very least. You're talking about 5 years, which should be an average holding for an equity investment, because you want there to be at least a cycle that you complete in the markets, right? What is the average good holding period according to you for an SIP? Of course, this is goal based, but at the very least, how much should it be?
So basically, if you ask me, at the very least, it should actually be your SIP should be running for 15 years. So you have
at the
an
very
average
least.
Yes, because you are looking, you want to create wealth, right? You want to create long-term wealth, right? So are you going to be excited with a 20% return, or are you going to be more excited that your corpus is 2 crores?
2 crores is an arbitrary number, but having said that, I take your point. But 15 years, Arvind, what do you think?
15 years is a dream, but I think 7 to 8 years is what we generally peg as the minimum.
Yeah.
Because I mean, to answer your question, I think anything lower than that, one should not do an equity SIP, because equity requires that you have to be in the market for minimum 7 years.
Okay. The last question, gentlemen, and this has to
Right?
do.
Can I
Sorry.
just interrupt?
Yeah,
So when I said in your SIP, your average holding is still 7.5 years.
fair
Mind
point.
you on that.
No, that's a fair point. So you basically divide it. But the last question, and this is obviously now, you talk about rebalancing of a portfolio and strategically rebalancing at that, right? So when you see a dramatic change in the asset allocation that you've determined, and you use that mathematical formula to enter, and you automatically enter at lows and you sell at highs. Now, is there a case to be made to make lump sum investments strategically along with your SIP? And therefore, should you use your cash reserves or whatever you have to do that? Juzer, quick point.
So I believe that the lump sum investments can be done when you see there is a suddenly you find that there is a sharp fall in the market. The more important is going to be is that what is your time horizon for holding that money. So if you are very clear that you don't need this money, if you have done something lump sum, then at that point of time I would look at it that if you are looking at like a large cap fund, then the minimum holding period should be between 3 to 5. If you are looking at a mid cap fund, it should be between 5 to 7. And if you are looking at a small cap, your ideal time horizon should be more than 7. Right? In between, if you make money and you get out, that's a different matter. But mentally, you should be prepared for these time horizons. That is very important.
Lump sum use?
I totally agree. If there is some periodic payments that you get and there is a sharp fall, then SIP combined with lump sums make great sense.
So in the next one of the next episodes, we'll try to quantify this so that you can understand the benefits of something like this. But do remember, I think for me, my biggest takeaway is to look under the hood of a fund to see what they are investing in before you make a call to invest in those schemes. Arvind has taken you through a couple of his picks, and we've also spoken about SIPs and the kind of strategy that you should employ. Gentlemen, thank you so much for taking the time and speaking to BQ Prime on the Mutual Fund Show.
Enough.
Thank
All right, viewers,
you.
and there you have it. That was a Mutual Fund Show. If you've got thoughts that you'd like to share with us, if you'd like to tell us about the topics that you want to listen to, then let us know on any one of our social media platforms, and do stay tuned. This is BQ Prime.